the community.
Hey, Equity Mate.
I just had a question.
Hey, Bryce, friend. I've got a question.
Welcome back to Equity Mates Investing. Markets are down, so it is certainly a buying opportunity. But the question that we have today is, should we put all of our cash in or should we dollar cost average?
And this conversation was sparked by a question from Casey.
Hi guys, firstly, thank you so much for all of the content you put out. It's really helpful and digestible, so thank you for that. I was just wondering what your guys' thoughts are on lump sum investing during a market downturn. I usually dollar cost average into diversified ETFs, but recently with the Trump tariffs going in and during previous market downturns, I've lump sum invested into those ETFs. I know you're not supposed to time the market, but it feels like a missed opportunity if I don't buy the ETFs I usually buy when the market's down. I was just wondering what your guys' thoughts are on this. Thank you so much.
Great, love that.
Love the question, Casey. If you want to ask a question, there's a link in the show notes or the YouTube description. You can write to us, but we'd love it if you recorded a voice note like Casey. So Bryce, where do we start? Lump sum investing or DCAing?
Well, I think we should start with the fact that if you do have a bit of a cash pile on the sideline, this is the time, as Casey has said, to get excited about it. Like we've spoken about on the show over the last few weeks that these opportunities don't come around all too often. And so it is time to put your money to work.
Yeah.
But I think people do get confused when we say, or listen to Casey and say, we don't have an issue with lump sum investing in times like this, but also don't try and time the market.
Yeah. So when we're talking about don't time the market, it's more about selling than buying, or it's about selling and then trying to buy again. And so the reason we say don't try and time the market is because if you sell and you get out of the market, chances are you're not going to nail the timing to get back in. No one, like even the best investors of the world, haven't shown a consistent ability to time the market well. And so who are we to think that we could time the market well? And the problem is when you're trying to buy and mainly sell, but then buy and sell, and try and trade your way through a market cycle, you miss out on those good days. You missed out on the majority of your return. You incur trading costs. You also just add a lot of stress to your life. So you're worse off financially. Your mental health is worse off.
Yeah, big time.
There's no reason to try and trade the ins and outs of the market. That's different to if you have cash on the sideline and there's a buying opportunity.
So I think long story short is we both have put money in. We've been opportunistic about this point in time. And so I think to directly answer Casey's question, I think what she is doing there and recognizing that there is an opportunity and putting money into the ETFs that she's already been buying is great.
Yeah.
Like if you have the ability to do so, great.
Yeah. I mean, everything Casey said in that question was like exactly how you should think about long-term investing. Have a consistent DCA strategy for whatever the market is doing, and then being opportunistic when the market is down and putting more in. Like that is great. Just keep doing that, Casey, and you're gonna do well.
And if you're sitting here being like, damn, I'm missing out because I don't have that cash pile available. A, lesson learnt. Try and make sure you do have some cash pile available. But also B, don't change your consistent dollar cost averaging strategy if you had one going in. Leave it. You're going to catch the market as it falls, and as it comes back out the other side, you're going to catch it as it goes back up. So whilst you feel like you might be missing the opportunity, you're actually not. This is the exact reason that you do dollar cost average, so that you can buy more on the way down.
So then the second part for Casey is, okay, so she's got this lump sum and she wants to put it in while the market is falling. But we don't know how long this market downturn will last. Like COVID was a classic example where it bounced so quickly that a lot of people missed the bounce. But then again, you don't want to buy when the market's fallen, 20% if it's going to be down 50% like the GFC 6 months later. You want to get it when it's down 50%. And so how I would answer this question is have your lump sum, whatever it is, and split it into smaller chunks and almost like do a mini DCA where say, if I've got $10,000 on the side over the next 5 months, I'm going to put 2,000 in each month. And so that way you're not trying to perfectly time the bottom, but you're just deploying that lump sum in a relatively short period of time. And maybe today's the best it's ever going to be. Maybe in 3 months it'll be down lower, but you're sort of getting whatever the average of this downturn will be. So that's how I'd think about it. Obviously.
What about for individual stocks? Is that how you would do it?
Individual stocks, I think it's more case by case, more opportunistic. If you wanted to put a big chunk of money into like one individual stock or a couple of, you could do it that way as well.
But I think overall the takeaway is whatever cash, it's like deploying all at once early on in these moments is probably not the best idea.
I mean, it's not the worst idea.
Yeah.
Like, there's nothing wrong with doing that. If it's like market's down 20%, put it
Go
all
for
in. That, like, great. Yeah, like there's nothing wrong with that.
But know that that's it.
But if the question was how I would do it, because in my mind I'd be worried I'm not getting the best moment, and so for everything we say about don't try and time the market and all of that stuff, you still want to feel like you've nailed it.
Of course.
And structuring it that way would just make me personally feel like I put some money in at the right time whenever that right time would be.
Yeah.
What about you?
I'm slightly less. This time around, I've been slightly less strategic on deploying cash from like a DCA point of view. So, firstly, what I haven't done is I haven't changed my original DCA setup. That's just it is what it is.
Yeah, and that's the same for me. The original DCA is just continuous.
Yeah, that's just continuing. So then I've got this cash on the side. And again, I keep referring back to COVID, but I feel like in instances gone past where we've had this opportunity, I've waited too long.
Yeah.
Because I've felt like everyone says, just see how it plays out. And I have kind of missed big opportunities to get in. So whilst I'm still absolutely have no certainty on where things are playing out, I've put in lump sums, but don't have like a strategy of, it's going to be once a month for the next 3 months. Yeah. I'm just like, shit, market's down 10% in 2 days. I'm going to take that opportunity.
Yeah.
Market's down another 5%. I'm going to take that opportunity until I effectively run out of cash.
Yeah.
And then I realize, and then I can kind of sit back and say, look, if the market falls further from here, so be it. I know over the long term it's going to improve, but at least I've deployed more money than I had if I was just sticking with the DCA at a time where there was opportunity to do so.
Yeah.
So yeah, for me, it's not all at once, but I'm not sort of sitting back and saying I'm going to split it evenly over a period of time. It's just like opportunistic.
So Casey, to round out your question, I think when we say don't try and time the market, it's more about getting money out of the market and then going back in. But we will never object to people putting more money in the market.
No, at any time.
At any time. Yeah. And don't invest money that you're going to need.
Yeah,
we should be clear about that.
That's actually a very good point, because I've seen some commentary in the Facebook community group about people selling bits and pieces and taking on a bit more risk because they're feeling like they're missing out. If you don't have the money available and you're putting money in that you are going to need beyond investing, don't do that.
Yeah.
Do not do that.
Yeah, you just set yourself up for risk. If the market keeps falling and you have to sell it to cover rent, or you're planning on going on a holiday and then all of a sudden you've got less money and so you've got to get a credit card to cover the holiday, whatever it is, like just don't take that risk. But if you've got dry powder on the side, if you've got money that's earmarked for investing and it's been waiting for the right time, well, now's the time.
Love it. Well, Casey, thank you so much. As Ren said, we really appreciate if you can leave us a voice message. So there'll be a link in the show notes or the description below. Otherwise, you can write to us and leave us a question at equitymates.com/contact. But that brings us to the end of another jam-packed episode. So much happening in markets at the moment. Join us in the Facebook community group. Follow us on Instagram. We are releasing information as we get it, and you can track how we are approaching our investing journey almost in real time in some of those other channels. But Ren, it's always good to chat. We'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful. Equity.